And now the same adjustment entry needed on 31st of December. So what is that? On July 1st, 2014, when the business collected 15,000 rent in advance, it debited cash and credited unearned rent revenue. Wow, this is unearned revenue case, which is when the first business received this rent in advance, so they added making the entry cash to unearned rent revenue, which means they created this liability, right? And now we have to reduce this liability against the revenue, because now after passing 6 months, right, July to December, it is 6 months. So 6 months revenue, we can now claim that that is we earned that one. So now the entry would be we reduce the liability, which is unearned rent revenue, to rent revenue. Now we can say that now we earned revenue. So let me just clean that one, and answer would be unearned revenue. We reduce the liability. Decreased liability means debit, and increased revenue means credit. So unearned revenue to rent revenue. The E part is that we are again making entry for adjustment on 31st December 2014. Interest revenue of 900 has been earned but not yet received. It means we earned but not received from customers, right? So we create customers and we create revenue. So entry would be interest receivable to interest revenue. Receivable means customers, right? The F entry is that, remember, we are making for 31st December 2014. Equipment was purchased at the beginning of this year at the cost of 50,000. The equipment useful life 5 years and there is no residual value, which means at the end of the 5 years the equipment value would be 0. Record the depreciation for first year. So what is the depreciation? It is the the cost of usefulness of the asset throughout its lifespan. So 50,000 divided by 5, answer is 10,000, right? When you record the depreciation, so what is the entry? Depreciation expense to accumulated depreciation, right? So let me just remove it and see the answer here, right? Depreciation expense to accumulated depreciation 10,000. And how are we going to show our assets? So we have F. Remember, we are adjusting the entry for 31st December 2014. Equipment was purchased at the beginning of the year. 50,000 determine the equipment's book value. So equipment was purchased for 50,000. Accumulated depreciation we just calculated over there is 10,000. Answer is 40,000. That is the book value, right? Let me just remove it to see the actual answer here, right? 40,000. So now let's start constructing the financial statements, because we have now we have seen all the adjustment entries, and now we're going to adjust it to make the financial statements. Let's see that. So in order to make the financial statements, what was the order? First we have to make income statement, and then from income statement we find out the net income, and that net income is used to construct the retained earnings statement, because that net income is going to be used here in retained earnings statement. So where this amount came from, this amount came from the adjusted trial balance, which means you add the adjustments to the accounts, and that value will be recorded here. So I'm just going to remove it and then see that. So this salaries expense came from adjusted trial balance, not the unadjusted trial balance, because there are some entries that we just discussed in our previous illustrations that if from prepaids, unearned revenue, accrued income, accrued revenues concepts. So after adjustment, these are the values after adjustments, mostly come from adjusted trial balance. So how we're gonna make the financial statements? First we're gonna make the income statement. Income statement, we find out income, net income. Net income is used to construct the retained earnings. What is the formula for retained earning? Beginning retained earning plus net income minus dividend, and then you have the ending retained earning, and that retained earning will go to balance sheet. Let's see that. Right from retained earnings, that retained earning is used in balance sheet under retained earning account. Right. So this is the balance sheet. This is the asset side. This is the liability side. And the liability sides under the stockholders equity, you see the retained earnings. So that is exactly the same amount. Right. Good. Our fifth learning objective is close the books. So closing the books uh, transfers revenue, expense, and dividend balances to the retained earning. So we know that expense, dividend, and revenue, these three accounts belong to retained earning accounts, right? So closing of the books means that you close revenues, expense, and dividend to retained earnings. So when we close the revenues account, so how we close it? We debit the revenue account and we credit the retained earning, which means revenue to retained earning. Closing of the expenses, so we debit the retained earnings and we credit the expense account. Similarly, for dividend, we debit the retained earnings and we credit the dividend, right? So let's see the illustrations here. So you see that in exhibit 3.9, the expenses, you see the expenses, dividends, revenue, right? They are in adjusted trial balance. This part of the adjusted trial balance, they need to be closed. So what is the end and what is the entry? Entry would be revenue would be closed down. So how we close the close the revenue? Because when revenue increase, it will be credited, but when you close it, you have to make reverse entry. So now the revenue is reverse, so revenue decrease means debit, and we close it against retained earnings. So we answer would be revenue to retained earnings, right? Revenue to retained earnings, right? Let me just close it down here. Revenue, service revenue to retained earnings 7,500. And expenses, so when expense increase, it would be debited, but when you close the books, entry would be reversed against retained earning. And now when you close down the expense, so expense, all the expenses are credited against retained earnings. So where this 4,600 came from, we just add the value 1000 plus 1800 plus 300 plus 400 plus 500 plus 600. What is 600? And the dividend, we close down the dividend. Similar treatment with the dividend. When dividend increase, it is debited. When we close down, we make a reverse entry against retained earnings. So dividend is credited against retained earnings, right? So what is the balance here? So beginning balance of the of the retained earnings, which is 18,800, that is the start of the previous beginning balance. So you see retained earning is credited by 7,500 and then debited by 4,600 and then debited by 3,200. So ending balance is 18,500. So the exhibit 3.13, it shows the closing of the books. So all the ledger accounts balances of the expenses, revenue and dividend, they are closed in retained earning. So the tidbit is like that, or the crux of this is that all the items of income statement, they must be closed against retained earnings.